Welcome back. You're still tuned into Inside Out. This is our Swotlight segment. Well, defense stocks have been on fire lately, and there have been a number of reasons for the same. We thought of picking up one stock and analyzing the same. Mazagon Dock is one of those stocks. Listed on the bourses in 2020, so not so old. The company is India's leading shipbuilding yard and the only shipyard to have built destroyers and submarines for Indian Navy. Now, the company has a huge product profile. In the naval platforms, they have missile boats, destroyers, floating border outposts, conventional submarines. In the merchant ships, they have general cargo vessels, there is windmill towers, water tankers, and in the oil sector, there is offshore platforms and jackup rigs. The financial performance has been strong as well, from 4,000 crore rupees in FY21 to as much as 8,000 crore rupees in FY23. EBITDA has improved in the same way from 800 crore rupees in FY21 to around 1,500 crore rupees in FY23, and profits have doubled as well to around 1,119 crore rupees. This compares with 500 crore rupees in FY21. FY23, in fact, for them saw the highest revenues and profit. And in FY24, company expects a growth of around 8 to 10%. And in this, repairing is also a segment which is around 3% of revenues. The total order book of the company is around 38,755 crores, out of which submarine is around 11% and the rest is shipbuilding at 34,399 crores. They expect this order book to be executed by FY25. Raw materials for the company, of course, are steel alloys, paint, diesel and gas, and each contract has fixed and variable costs. Now, there are two kinds of orders: nomination-based, where the margins are anywhere between 7.5% to 8%, and competitive-based, where the orders are based on competitive basis. This again has two components. One is the new builds and another is repair and maintenance. In case of competitive orders, repair and maintenance segment is one where comparatively better margins are expected. The shipbuilding contracts have variable component of 50% and the rest is fixed component where the scope and price is fixed. The capacity of the company is 11 submarines and 10 warships simultaneously. So the company says, as far as the capacity is concerned, there is no constraints with respect to that. And while their margins have been improving, company says for margin improvement, deliveries have to be in time. Whenever the deliveries are in time, it definitely has a significant positive effect on the margins. Because as far as the contract value is concerned, contract value remains fixed, but costs go up if there are delays in delivery. So this is a key to track. Now on to the balance sheet, because they have 13,286 crore of cash and cash equivalents, which includes advances to the customers. Receivable days at 47, which have fallen from 64. Inventory days have fallen to 343 versus 490 days, and inventory days are higher in this industry. Company has maintained higher dividend payout to the tune of 36%. But the risk is a big exposure to the government space. So the Make in India push needs to continue for these companies to do well. Government holds 84.83% stake in the company, so the minimum public shareholding norm needs to be met here. Stock reasonably priced at 15.5 times 1 year forward earnings. Okay, with that, we have run out of time on this episode of Inside Out. It's a goodbye from Nigel and I. But do write to us and tell us the companies you want us to discuss and you want to hear about, and we'll feature these on our show. Thanks a lot for watching.